Hello and welcome to the video on strategic cash flow management. Most sellers are managing cash flow by what I refer to as tactically. That means every day or every week they're worried about whether or not they have enough cash. Does that sound like you? Well, you're not alone. This video, however, walks through how you can lengthen your horizon and design a cash flow program so that you don't have to follow the day-to-day, but instead can be more strategic regarding the business. The first thing that we're going to walk through is we're going to talk a little bit about how cash flow will impact your valuation, because it's very important not just to think of cash flow as something that affects your operating of your business, but it actually affects the valuation of your business as well. Then we'll start talking about how you can determine the amount of cash you need to grow, the real amount of cash that you'll need. We'll then talk a little bit about cash flow management as a process, not as a one-time event, i.e., I'm broke, I need cash, let me go try and find where I can get it. Okay, let's get started. First of all, how important is cash flow in e-commerce? I don't know if you've heard the expression, but it's a common one they say is cash is king. And we say, no, it's not. The reason is that it's both the king and the queen on the chessboard. Sure, without cash, cash is king, the game is over, that's true. But for e-commerce, cash is also the most powerful way for you to scale growth, which means it's also the queen, which is the most powerful piece on your chessboard. Let's talk about how you can leverage cash, not just to exit your business, but to scale it more profitably as well. There's three different aspects that I want to talk through on the impact of valuation. The first one is that cash flow can actually, depending on the type of deal that you have, particularly if you're doing a private equity deal, it can literally change the amount that the valuation of your company is calculated based on. However, beyond that, it will also help you focus on more and more profitable growth, which will increase the valuation of your business as well. And then finally, recognize that given two options, buyers would always prefer to buy a more cash efficient business. So being highly cash efficient will actually bring new buyers to the table. Let's talk through each one of these scenarios in some level of detail. Okay, the first one is a private equity deal where working capital is set at a peg. We'll explain that in a little bit here, at the average of the last 12 months. So if you notice down at the bottom of the screen, there's what's called a cash-free, debt-free adjustment to valuation. This happens in virtually every deal. And in essence, what it means is that you get to keep your cash that is built up in the company, and you have to pay off all of the debt or liabilities for the company, even if those are money that you've put in and you've loaned the money to yourself. So in the first example we'll walk through, as you can see, you'll have $100,000 in cash and $100,000 in debt. So you'll essentially be break even from a cash-free, debt-free basis. But in the other example, you'll have built up $500,000 with no debt, and we'll talk about how that impacts the valuation. Okay, we're going to use an extreme example to set the point. The first one is that you don't pay 70-30. You actually have to pay your supplier 100% upfront before they do anything. And again, I'm using this just to illustrate an extreme example. The principle will apply regardless of what your payment terms are. The second one is you pay your supplier nothing until the goods sell from Amazon and you get your cash. So in other words, you literally don't have to pay a dime to your seller until you already have the money in your bank account. Okay, we'll start with the same $1 million profit company in both examples. And we're always using multiples here just as examples rather than saying that your business is worth a particular multiple. So let's just set this at 4, and we've got a $4 million transaction. Okay, as we talked about, you get to keep the cash and you have to pay off your debts. That's what cash-free, debt-free means. And in the middle, there's this thing called working capital or net working capital, which we've talked about before. It's essentially current assets minus current liabilities, which for the sake of simplicity in this example, we're just going to assume that the only asset and liability is your inventory. We're going to ignore things like your accounts receivable from Amazon and other types of payables that you might have. Again, it will highlight the point of how important inventory and supplier terms are to your deal. And then when you net all of that out, you'll get what you receive when you sell. So in the first example, you've got $100,000 worth of cash and you've got $500,000 worth of inventory. And because you don't have any inventory payable of 0, you don't need that because you've had to pay your supplier up front. So you literally never owe any money to your supplier. And as you can see here, that means that you have a net working capital of $500,000 of inventory minus the payable, or $500,000. And that's going to be set as your net working capital peg, because that's the average amount of working capital that you need to grow the business. And for most private equity, your net working capital average is built into the price or the multiple that they offer you. So the money you receive when you sell would be $4 million, and you would have a net working capital peg of $500,000. In the second example, you have the same $500,000 of inventory, but because if you remember, you don't pay your supplier until the goods have sold. If you haven't sold the goods, they're still on your books for inventory, which means you now owe $500,000 on that inventory of $500,000. That means your average net working capital is your asset of the inventory, $500,000, minus the payable of $500,000, or zero. So interestingly enough, the net working capital peg goes down when your payable goes up, which essentially means that it's good to owe your suppliers money because it reduces the cash that you need to run the business. So in this example, because I don't have to pay any money to my supplier until I have it, I literally can run the business with no net working capital needs. Again, I want to really demonstrate this as an extreme example so that you can start to see the impact in a very clear way. Well, what happens to that $500,000 then is that it tends to show up in your cash account or in lower debt, because I don't have to borrow money in order to grow inventory, and I don't have to pay my supplier until later. I've now built up cash reserves and I don't have to go borrow money. Well, here's what happens in that instance. The price that you would get for your company in a private equity deal between these two companies is actually $500,000 difference, because the net working capital is now $500,000 in example 1, but it's only 0 in 2, and the cash-free, debt-free is yours to keep. Let's walk through that visually. So as we know, the cash is yours. That drops down, $100,000 drops down, that's yours to keep. And in the second example, the $500,000 drops down, and that's yours to keep. Then we bring down the debt. So the debt comes down. Here I've got the $100,000 that I owe. So if I look at the sum of those two numbers, that is 0 that I get. So I take my $4 million, I add the adjustment of 0, and I'm still at $4 million. But in the second example, I don't have any debt that I have to pay down. So I take the $4 million that I had up top and I add the cash-free, debt-free adjustment, and I end up with $4.5 million. So now when you talk about the next question is, where did that cash come from? And it came from two places. The $500,000 that you had borrowed from your supplier in the second example actually means that you didn't have to write a check for them to pre-purchase inventory, so you still have that money in your cash account, the $400,000 of it anyway. And then the second part of it ends up that you didn't have to borrow money from a lender in order to pay for those inventory. So the difference is that you have money in the cash account and you don't have a debt. And interestingly enough, as you can see, you don't have to deduct the liability to the supplier because that's part of your net working capital calculation. So the key part in understanding this is that there's a net working capital peg that is set at how much cash do you need to grow. And in most private equity deals, that will be built into the multiple that you pay. Unlike a lot of Amazon maybe deals with aggregators where inventory is separate. It's important to realize that this is just one example of how it can directly impact you. But even if a buyer is going to quote unquote give you credit for net working capital, that doesn't mean that they're not calculating it and they're not realizing that the cost of their business is much higher to acquire you if you're not cash efficient. Let's walk on now to the second example. Okay, the second example, same example, but the difference now shows up that if you didn't have to pay your supplier until your goods sold, the logical question would be, how much more growth could you achieve if you could do that? And for here, I've just literally built in a 10% lift. Now, if I asked most Amazon or e-commerce sellers, If you're going to run two different businesses, one of them is you have to buy all of your products up front, and the other one is you don't have to pay a dime until they sell. If you could only grow by 10% more, they'd say probably not. They could probably grow by 20 or 30% more. But let's use a conservative example. Okay, so the second thing is if you're growing faster and you're more profitable, you're probably and more cash efficient, the buyer is going to actually be a little bit happier with you. So the 4 times multiple is actually going to become 4.1. Again, just a 10% lift due to the fact that you're more cash efficient. So if you look at the combined impact of those two numbers, you see the 1 million here has gone to 4 million on a 4 multiple, but the 1.1 times 4.1 has given you an extra $500,000 by being cash efficient. This is what I call the second impact, or the indirect impact on your valuation by having great cash flow. And then all of the other things kind of stay the same. So you still have your working capital adjustments, you still have all of those different types of things in there. And as you notice, when you now get your inventory paid separately, you get 4.5 million for the second deal, but you've got 5.5 in the third deal. So you've got another impact on your valuation. And let's now just go to the last impact, which is buyer preference. The simple way to think about buyer preference is this. If you double the company of size of option 1 and you double the size of company 2, which one is going to need more cash? Well, the answer is pretty obvious, right? In one of them, I need $500,000 of cash in order to reach $1 million of profitability. If I'm going to double it and I have to buy twice as many goods from my supplier, I'm probably going to need another $500,000. But in the second example, again, extreme to illustrate the point, is that you literally need no cash to grow with your inventory purchases because of the fact that you're not paying until after you receive the money from your Amazon or e-commerce Shopify accounts. So where does that mean? If you were a buyer, simple question, which one would you rather buy? And the answer is, the bottom line for a buyer is that whatever they don't have to put into additional cash into the company to grow it, that just allows them to have more cash to decide to pay for you. So if you think about from the third impact is that you're going to open up additional buyers. We actually had a situation like this that happened. We had created very favorable supplier terms. We literally landed the buyer because of all of the e-commerce companies that they were looking to buy. This one had the best cash flow so that they could immediately scale the business and drive the profitability higher, which is exactly what they did after they acquired the business. Okay, what did this just illustrate? Is that there's a strategic version of cash management which is different than tactical. Tactical cash management is you don't know if you have a cash flow problem or a profitability problem because you haven't analyzed your numbers, but you just seem like you're always out of cash and you're having to manage it day by day or week by week. And you're probably losing 20% or more of your productivity and profitability because you have to airship or you get stockouts or you're continually worrying and having stress and bad decision making because you always feel like you're running short of cash. Strategic cash flow management comes in is when you've already done some of the work in the forecasting and the budgeting that we talk about, and you know that your business is profitable and you're now leveraging cash to scale it more efficiently. Because you've scaled your cash needs, you've also added in a buffer to make sure that you have enough cash for your higher level of growth. You don't have to worry about payments week by week, but you're focusing more on cash and cash flow fluctuations over a longer period of time. Maybe you have to manage it a little bit during peak season ordering, but in general, you're not worried about cash all of the time. And that allows you to focus on the vision of the company to have higher productivity in the business and lower stress. That's the difference between thinking about cash strategically rather than tactically. There's two different ways that you can determine how much cash you need, which is the logical next question. The first one is I call a bottom-up approach. And what you do is you take your current forecast that you've developed, the units per day and the growth percentage, you apply supplier terms to that so that you can figure out your ordering volume and your payment schedule. You then look for cash for new product growth, and you have to determine what your launch period is and how long you're going to need in order to grow it. And then you have to determine what the long-term growth trajectory is. You then forecast cash for new expansions beyond new products, which would be marketplaces first, and then other channels such as wholesale, retail, and or direct commerce, eShopify, those types of things. And then you have to look at seasonality. You apply the forecast that you've done on a per product basis against historical trends of seasonality. But for most people, seasonality changes enough that you have to look at it each and every year. And then you have to apply that as a factor. So if you're in the high season, you might have to apply a 1.4x factor to your ordering volume and your cash needs. And then you determine what additional cash you need for overhead if you're going to staff up to reach your new level of growth or any of those types of things. And finally, you add in a buffer. And I would recommend that you start with a wide buffer. And then remember that you're going to always have the problem that if you get cash in and you can grow faster and you don't have good cash flow efficiency, you're going to need more cash. So remember to be ahead of the curve and buffer to try and get as much cash as you can early because you're probably going to need it. This is referred to as a bottom-up cash flow approach. It takes some time and some steps, but it is the most accurate one in terms of if you could implement this on a monthly basis, you'll start to strategically see in a much better light how much cash you need. If you don't want to take that approach, there's also what's called a top-down approach by looking at your historical balance sheets and making some estimates. Let's take a look at that approach. You take the last balance sheet that you have or your last 3 months average. And as you can see here, I've got some cash and I've got some liabilities and I've gotten some money out of the company. You separate that out by calculating what's your net working capital. And as you can see there, we've eliminated the cash and we've limited all the other equity things. And all we're doing is looking at your accounts receivable and your inventory asset, and we're subtracting out your payables and any other supplier payables that you have. And in this particular example, you have a net working capital of $80,000, which means, if I'm translating it into another way of explaining it, is that on average for this size business, you need about $80,000 of cash to continue to be as profitable as you are. Then what you do is you add in the same expansion capital that we did on the bottoms up approach, but you don't do it on a per product basis. You just say, you know what, I think I'm going to release 5 new products. I think they cost about $20,000 a product. I better build in $100,000 for that. And I better build in another expense of $25,000 in marketing to promote those particular products. So you add in your expansion capital. You then, the last step is you add in your forecasted growth. And if I'm getting 25% bigger, I'm going to generate some pre-tax income. So I'll have a little bit of cash flow coming back into the company. But I'm going to need, instead of $80,000 of net working capital, if I'm 25% larger, I'm going to need $100,000 of working capital. You add in your expenses, you add in your rainy day fund or your cushion, put it in as a negative number in the worksheet that we're providing you, and you find out that you're going to need another $181,000 in order to grow. And that lets you know what the true cash need is that you have for the business on a top-down approach. Now, it's not going to be as accurate as the detail bottoms up, but rather than not doing cash flow forecasting at all, which I think is critical to the success of your business, it's at least better to take one of these methodologies and make sure that you implement it on a monthly basis. And the two methods are not mutually exclusive to each other. You can use them in combination, and the way that you do that is you look for alignment. You do the bottom up and it says, okay, I need $250,000. And then you do, the top down says I need $250,000. And then you do the bottom up, which says I need $275,000. And you go, okay, that's pretty, close to each other. I think I can move forward and I need to start looking to secure that level of capitalization. The key takeaway is if they're in alignment, great. However, is if one of them is a lot different than the other one, then you better go back and refine them because something's not matching up between your forecast and your balance sheet. Now, it could be that you have a lot of growth planned and that's what's driving it because it's not showing up. But on some level, they should be relatively close to each other. Okay, the last part of this video is to talk about how do I make this a process, not a one-time event? And the answer is you have to be proactive first. Most people look at their cash flow only when they're broke, And if there's one immutable law that I've found in all the years that I've been in business, is that when you actually need money and you need somebody to borrow it to you, nobody wants to. It always seems to work out that then your numbers aren't as strong, or maybe that you look riskier to a particular lender or even an equity investor. So when things are going well and you've gotten a lot of cash, maybe from a peak season, that's the time to go out to the marketplace and secure the right amount of capital that you're looking for. The second thing is you have to continually update your cash flow needs based on your current forecast. Otherwise, you're doing what we talked about before, which is you're just driving looking in the rearview mirror rather than out the front dashboard. And then always include a buffer, because you need to have more cash than you think you do. Things either take longer or they're more expensive. That's just the general rule. So make sure that you start to make cash flow management a process and building in a budget for the future. Okay, so let's get to the action item of this video. The first thing is make the tactical to strategic shift in your cash flow and really start looking at your cash flow needs, not week to week, but over the next 6 or 12 months. Start securing cash when you don't need it, which means that you'll have it available for when you do. And then finally, start adding into that monthly financial process where you're looking at your historical accounting, cash flow management, and each time that you update your monthly accounting numbers and get them from your bookkeeper, look at your cash flow needs and update the workbook sheets that you need. Study your cash flow statement every month, and then work with your finance team to implement a consistent cash flow forecasting process. Last thing I'd like to mention to highlight how important cash flow is to your business is I once had somebody ask me, Scott, you've done many 8-figure and even low 9-figure exits. What do the big people do? And when they exit for big dollars, what are they doing right that I might not be doing? And I come down to 3 different things. The first one is they're extremely focused. They don't get involved in all kinds of different types of things. They find out what's working in their niche. They keep expanding it. They do it well. The second thing is that they have aggression. They know that something is working. They're not afraid to invest the dollars that it takes in order to get to the top of page 1. And then the third thing that they all have had is they've had plenty of capitalization so that they can aggressively focus on their growth and drive their valuation higher. And if you ask me, what is the thing that people tend to lack, is they lack the capitalization to, when they know they have a winner, to aggressively continue to expand through size variations or product variations or different types of things in their niche in order to drive their valuation higher. So this valuation and cash flow linkage is absolutely critical to you. I know we did a deep dive into it, so you may need to watch the video again, but really focus on how cash flow affects valuation. Focus on it as a management process so that you have sufficient cash to fund your business going forward. And then don't just look at your historical numbers, but relate the cash that you need to the go forward forecast as well. Thank you.